The risk of investing in a hedge fund. Hedge funds, like any other investment, have risks that can be classified as either investment risk or operational risk. Investment risks are where we take an actual investment view and are either rewarded or punished for that investment view. An operational risk as a negative asymmetric payoff profile. Investors are not compensated for taking operational risk. That is how risk is broadly classified. Investment risk is simply the risk assumed by investing into underlying instruments, same as with any fund. The particular investment risk of hedge funds is that because the strategies are so absolute return focused, the risk is there that if the equity and the bond markets go on an incredible bull run, hedge funds may miss out. Conversely, of course, hedge funds are likely to offer more protection in a downwards market, and over time one would expect this to accrue in the hedge fund's favor. However, the timing around the entry here, and of course the risk of concentration where one do not build a properly diversified portfolio, is very real in terms of the investment risk in a hedge fund. Operational risk are those risks that are not meant to generate returns, as investment risks are. Something that the investor is not rewarded for and should therefore be avoided entirely. Under the pre-regulatory regime, where hedge fund managers manage their own cash, manage their own administration, there was significant operational risk. And some of the high-profile blow-ups we saw in the American hedge fund space, the likes of Bernie Madoff, are examples of serious operational risk where hedge funds were essentially a closed loop with investors getting very poor disclosure and investment managers effectively controlling the entire legal structure of the underlying hedge funds. Under the post-regulatory regime, SISCA, in the South African context, all the protections afforded to unit trusts where we have independent administrators, independent control of the cash, independent custodians for the underlying instruments. The hedge fund manager himself only manages the investment strategy. They cannot touch the underlying securities or the underlying cash. That is the level of protection afforded from an operational perspective to a hedge fund investment now versus pre-2015 when this regime changes. So essentially, the operational risk between a traditional unit trust and a hedge fund unit trust are the same, with the exception of counterparty exposure to an underlying prime broker. So this is an exposure very specific to hedge funds and something the market should be cognizant of. The derivative instruments are offered by banks, and in taking derivative positions, hedge fund managers are exposed to banks' counterparty risk. So ensure that your hedge fund manager is using a sustainable, properly capitalized bank who is a good counterparty in any given transaction.